I'm using AI like ChatGPT and Grok to assist me in stock picking. This is a part of my YouTube public portfolio where I will be picking a different stock every week. The first step for today is I'm going to be using Grok to see what are the latest product trends that are being talked about on X.com. And it's giving me stuff like technology, fashion, health and wellness, consumer electronics, and miscellaneous trends. So as I was looking through this list, the event-driven product launches caught my eye. Celebrity appearances and collaborations at events like those at, however you say that, or Gateway, significantly drive product interest. So I thought I would ask a follow-up question. Please expand on event-driven product launches. What products are celebs pushing the most right now? So gave me a list. Similar topics as before. We got fashion and accessories, beauty and skincare, health and wellness, tech, consumer electronics, and beverages, and then collaborative products. So in this case, I decided to look more into the health and wellness category. Specifically, I thought I would look into supplements. So the next step is I take supplements and I go to ChatGPT and I ask what publicly traded companies are in the best position to benefit from a rise in health supplement sales. So it gave me several companies here: Herbalife, New Skin, Usana, Chromedex, and Simply Good Food. So it gave me 5. Now, typically, I want to start out with at least 10 companies to take to the next step as I try to narrow these down. So I said, please list, I wrote list. Please list 5 additional companies. Gave me 5 more: GNC, Vitamin Shop, Blackmore, Medifast, and Nature's Sunshine Products. However, is not on the NASDAQ, so I said replace Blackmore with a company that trades on the New York Stock Exchange or the NASDAQ. So it gave me CVS to replace that one. This is on ChatGPT 4.0. So I'm going to go to the more advanced ChatGPT, which is O1. And this is where I want a little bit more powerful logic for this follow-up question. I'm asking it to rank the following companies in terms of financial health, take into account liquidity, solvency, profitability, and operating efficiency. Please use stockanalysis.com for the latest quarterly reports. So then I list the 10 stock tickers. So in the past, I noticed that if I don't specifically ask it to use stockanalysis.com, it will get some of the details incorrect. I asked it things like, what is the revenue? What is the free cash flow? What are some of the ratios, like the quick ratio? And it got these numbers slightly wrong until I asked it to specifically use stockanalysis.com. So I do that every time now. The top 5 in terms of financial health are CVS, Medifast, Simply Good Foods, Usana, and Herbalife. So I'm taking these 5 to the next level of analysis. That's the way I typically like to do it. I like to start with casting a really wide net and then narrow it down to 10 companies in a sector or a category that I find interesting or compelling in a way that I think it has potential to grow in the future. So in this case, products that are being talked about a lot on X.com and are being pushed by celebrities. So get that to a list of 10 companies, narrow it down to 5. The next step that I used to narrow this list down to a single company that I want to look into more deeply is I like to look at valuation in terms of free cash flow. So I've got this free cash flow analysis spreadsheet that I built where if I type in the ticker, it will automatically scrape information from the web right here. So I've got some formulas in here that give me capital, expenditures, cash acquisitions, free cash flow, shares outstanding, etc. So it automatically brings in all that information and then gives me some graphs where I can quickly get a feel for how is this company moving. In this case, for CVS, the free cash flow had been trending up, but over the last 12 months, it has dropped off quite a bit. The price to free cash flow ratio, so how expensive is the share price compared to the free cash flow that it's generating. Generally, a higher number is worse. So I can see because the free cash flow is dropping off, the ratio got worse recently. These are the shares outstanding. I like to look and see, are they increasing the share count a lot? Are they diluting the ownership? So if I buy shares, can I reasonably expect my shares to get diluted? In this case, over the last 4 years, they've actually been reducing the share count. Now, in 2019, they increased it substantially. So if I do want to look into this company further, that would be something that I would specifically want to look at. And then the revenue projections for the next 3 years, it looks like they're projecting about 5% revenue growth over the next 5 years. Let me go on to the next one. This one is Medifast. So I just type in med, automatically fills everything out. Medifast is relatively flat free cash flow. The ratio's gone down quite a bit. The share count has been reducing, which is good, but the revenue projections are pretty bad. So big revenue drop off in 2024 and then not much better in 2025. They're expecting to lose almost 15% of their revenue in 2025. So I think I will pass on Medifast. Next up, Simply Good Foods. Simply Good Foods has been trending down in terms of the last 5 years, but over the last 4 years, they've been going up. So that looks good. Their price to free cash flow ratio is relatively low. Their share count is staying relatively flat, increasing just ever so slightly. And then revenue is projected to increase by 12, 6, and 5% respectively over the next 3 years. So this one looks decent. I think I could look into this one further, but keep going. On a health, dropping free cash flow, ratio staying flat, share count is dropping, and revenue projections are pretty bad. So revenue loss in 2024 and then pretty flat in 2025 and 2026. So USANA is a no-go. Finally, Herbalife. Dropping free cash flow, not what I like to see. The ratio is dropping, which is good, but I would rather see an increasing free cash flow. The share count, it's been dropping actually, been staying flat the last 2 years, and then revenue projections are pretty bad. Basically, almost zero revenue growth over the next 3 years. So out of all of these, Simply Good Foods is looking the most promising. So this is going to be the first one that I perform a free cash flow valuation on. I try to calculate the intrinsic value using my projected free cash flow growth based on past performance and free cash flow growth based on what the professional analysts project for the future. So this is my spreadsheet that I use for projecting the intrinsic value of a company. So just real quickly, these are the cells that I have to input data. Once again, if I put in the stock ticker, my spreadsheet will automatically crawl the web and grab all the relevant information that I need. These 3 cells are for my projections, so I will leave those blank for now. The perpetual growth rate is how much I'm projecting the company will grow into infinity after the next 5 years. So I typically just put in the rate of inflation there. So I'm assuming it's going to continue to grow at an inflation rate of 3%. And then the discount rate, this is the discount that I would need to be compensated for how risky this holding is. So I'll just Google Simply Good Foods discount rate, and then Alpha Spread gives me this figure right here. Next, the minority stake, I also have to look up. I haven't found a good way to automatically enter that one in, but once again, I just Google it right here, minority interest. So there's 0 minority interest. And then the shares outstanding, free cash flow margin. This is the percent of revenue that is free cash flow. Here's the graph for free cash flow margin. The free cash flow margin has been increasing over the last 5 years. This is the average. So assuming that's flat over the next 5 years, and also assuming we continue with a 10% revenue growth. This is the past revenue growth over the last 5 years. If these figures remain constant, then the fair share price is $46 per share based on free cash flow projections. So currently, Simply Good Foods has a share price of 38.58. So that looks really good to me. The fair share price is actually higher than what the current share price is. So that's looking really good. And then if I go to the analyst projections, I'm pulling the analyst projections from stockanalysis.com. So if I go to forecast, here are the revenue growth projections. So the high projection, they're showing 2025, 16. There's an average projection for all the analysts and then a low projection. So even the lowest analyst projections are showing pretty much flat revenue, and then the highest analyst projections are showing moderate growth. So if the low analyst projection is what ends up happening in the future, the fair share price is $33 per share. So it's not much lower. If the average analyst projection materializes in the future, the fair share price right now would be $40 per share. If the high analyst projection materializes, the fair share price is $47. So this is looking really good to me. Now, this is where I kind of put in my personal projections right here, looking at the free cash flow margin. If I assume that the free cash flow margin continues to creep up over time, what I would do is I would add a 1% increase per year into the free cash flow margin growth column. And so now you can see the red is the average, the yellow is my prediction. So to me, I'm just going to go with roughly what's been happening in the past. If that continues to increase in the future, and then the past revenue growth has been 10%, I will call it 5%. If we see a free cash flow margin growth of 1% going into the future and an annualized revenue growth of 5%, my projection for the fair share price today is $51 per share. So given that the current share price is sitting at 38, I think this stock looks pretty good. So my question here would be, do I have any reason to believe that they could continue to increase their free cash flow margin and increase their free cash flow? So to answer that question, I'm going to go to their SEC filing, and over here we can see their operating expenses. Are they going to be able to get their operating expenses expenses down going into the future. So their big expenses are selling and marketing and general and administrative, depreciation and amortization, and business transaction costs. Is there anything outstanding in the last couple of years that could hint at the direction of these costs? If I scroll down to some of the descriptions here, we can see business transaction costs. Business transaction costs were $14.5 million the last fiscal year, which comprise of expenses related to OWYN acquisition. So in the last year, they had an extra $14.5 million in acquisition costs. They acquired only what you need, which is a dairy-free protein shake and snack company. My assumption going forward is that they're going to have fewer acquisition costs and they're going to have fewer general and administrative costs associated with this acquisition. So in my mind, it makes sense that their operating expenses would go down because of those two expenses going down. And I'm also expecting to see some additional revenue because they acquired this company. I'm assuming they acquired the company because they project it's going to help them grow and acquire more revenue and increase operating efficiency as they scale up. So I think it's a reasonable assumption to say that, yes, their free cash flow margin on average could increase over the next 5 years. If that were the case, then I would be happy buying this stock at $51 today. However, it's $38.50 today. So this is going to be the stock that I purchased this week. I'm going to be buying $100 worth of this stock. And then next week, we'll see how the stock price is moving. And of course, what is the next company that I'm going to be buying? If you're interested in seeing a breakdown of different ways that I use AI to invest, check out this video right here where I use a combination of ChatGPT and Grok to find companies that have shifted in recent public sentiment. And I'll catch you in the flip side.